Well, I'm glad to say that we're now joined by Gary Parr. He's the Deputy Chairman of Lazard. And I want to remind our viewers that, Gary, you were involved, of course, in the sale of Lehman's North American banking unit to Barclays, also to the sale of Bear Stearns to JP Morgan. So a lot of big deals during this crisis. So you're certainly somebody that we want to talk to about where we go forward in the banking industry. But before we get to that, I want to get to the news of the day, because everyone is focused on these compensation packages. What are these companies going to outline, to Ken Feinberg when they give him his proposals tomorrow? How much is that going to change the game on Wall Street?
I think it's probably too early to tell. The companies are putting their proposals in. The government have taken their positions, particularly Congress, putting out ideas. And so now the negotiations begin, and it's going to be months. So I think there's a lot of noise currently around positions that are each taken at extremes. And somewhere in the middle will lie compensation packages that will include a lot more stock, probably vesting periods, more transparency, and more tie to risk. But where exactly it lies has to be figured out over the next few months.
There's always worries, Gary, of course, right? They're always going to overshoot to the other side because we're trying to make up for past ills, I guess you might call them at some point. Are you worried about that, though, this time happening around if the government gets too involved in compensation?
I think, I really think it's too early to know. It is one of the risks and one of the concerns. One of the other interesting concerns is that markets are measuring against and competing against one another, meaning the U.S. is thinking about compensation controls, but so is the U.K. And so the U.K., London wants to be a financial center, of course. New York still wants to maintain its financial center. How each of those approach compensation may have influence about where shifts are. So that's going on as well.
Where talent goes, essentially.
Exactly.
Okay, now, before we get into M&A, because I know, of course, you're one of the leading advisors on M&A transactions, talk to me about regulation. How do you do M&A in an era where you don't even know if the government's going to change the game in the middle of it?
Well, it's interesting. There are a couple of elements of uncertainty around M&A, one being the regulation. And indeed, post-financial crisis, a lot of the regulation that's been discussed or will likely be implemented hasn't been yet. So it still is an unknown. What capital requirements will be, how big too big is one of the big issues that floats around, that regulators have still, at this stage, been dealing primarily with problems, existing problems, rather than taking the time to put in the regulation forward-looking, which they will get around to. That's important. Treasury, of course, have put forward a white paper. But there's a lot to come. And
but are we headed in the right direction, you think? I
think so. I think there were lessons learned out of the crisis. There are some degrees of regulation tying together, for example, the Fed's suggestion that since they have the balance sheet to lend, they should have more regulatory authority as relates to certain institutions.
And you're fine with that?
I'm good with that.
Okay.
Also, the idea that where AIG had a trading business away from the regulated entities and it fell outside of regulation is a bad idea. Yet it lived on the benefit of the big balance sheet. So capturing things like systemic risk, financial risk in an enterprise, those are good ideas.
And just very quickly, Gary, because we're coming up against a commercial break, but you've said before that you haven't seen any evidence that repealing the Glass-Steagall Act actually prompted this crisis. So what is that evidence that you're not seeing, essentially?
Right. Well, I'd say two things. Glass-Steagall went away a long, long time ago, 1934. Thereabouts, and it didn't create a crisis anytime near. The other is look back at the financial institutions that did get in real trouble. On the one hand, Bear Stearns, Lehman Brothers, those had nothing to do with Glass-Steagall. They would have existed as standalone securities firms. And on the other hand, some very big banks, WAMU and others, got in trouble having nothing to do with securities.
Nothing to do with, with Glass-Steagall at all.
A lot of the biggest problems had nothing to do with the wall between investment banking and banking.
Okay. All right, Gary, thanks so much. And of course, you're going to stay with us. We're going to talk sovereign wealth funds. You've advised, been in those deals with Kuwait into Citigroup, China into Morgan Stanley, and they're apparently about to come back. Okay, we're back with Gary Parr, Deputy Chairman of Lazard. And Gary, I wanted to talk about your expertise, which is mergers and acquisitions. And there was a recent report out in Business Week quoting Dealogic saying that we all know mergers have gone down in the first half. Actually, in the last 12 months, really, we've seen a huge decline. But merger arbitrage returns, they've actually increased lately. So is that a sign that we may see mergers come back? And will they at all come back to pre-crisis levels?
Well, as to arbitrage, the markets are much more illiquid, and there's a lot less capital being put at risk, which creates spreads. So that's created a higher level of profitability. As to merger activity, we've seen across all industries, of course, it's slowed down. We expect it will begin to increase slowly next year and continue for some years. Within financial institutions, a lot of it, that's been actually a very active area, but not in the old historic, general, usual M&A.
Right, you were saying Bank A with Bank B.
Exactly. Simple transactions aren't happening. They're highly structured, complicated, but they're happening, such as Barclays selling their asset management to BlackRock, which created the largest asset manager in the world.
Yeah, and why is that? Why are these working and not the others?
Yeah, that's because there are a lot of things that have to be sold. There are a lot of businesses that will be sold. AIG has businesses, Citigroup has businesses. There are a number of financial institutions in Europe that are selling. So they need to sell. Very few buyers have all the cash. So you have to structure where you raise money, raise capital, take seller financing back. And by putting all those together, you can accomplish the strategic objectives of moving businesses where they belong.
I also have to imagine, Gary, and we were talking about, and you sort of alluded to that earlier, was that, you know, banks now that they're more heavily regulated, are going to have to hold more capital.
Right.
And that means a lower rate of return and all of that stuff. Does the fact that these banks have to, you know, keep more of a capital cushion, I mean, you know, doesn't that mean that it's going to be harder for others to really be attracted to buying them, for instance, because they're going to have to pay a premium on that capital? I mean, that's going to be also inhibitory, right?
It would in the long term, but in the short term, there are a number of institutions that are still short capital and or need to restructure their balance sheet. And that's where capital can come in. Failed institutions that need to just be recapitalized, where the FDIC takes them over, that will happen. There'll be a number of other institutions that need to, again, repair their balance sheet. That creates the hole. But over time, yes, when banks meet their capital requirements and stabilize, then what to do will be probably, then we go back to more traditional mergers where two well-capitalized banks merge in order to get cost savings.
Right, and get that synergy going, the quote-unquote synergy. Okay, sovereign wealth funds. You say they're about to make a comeback. Why?
Yeah, it's interesting. So everyone remembers that sovereign wealth funds invested early in a number of institutions and lost quite a lot of money. They did. But the inflection point was crossed sometime late last year, early this year. And so for now, there are the examples such as Abu Dhabi investing in Barclays Bank, and they made a 50% gain, a multi-billion-dollar investment. Mitsubishi, that invested in Morgan Stanley last November, made a $9 billion investment, and the stock is above where they invested. So not only do they have a great strategic alliance, but they're actually making money on the investment. So now we're seeing people, in fact, sovereign wealth funds and other institutions, foreign, make money on their investments. That attracts capital. And BlackRock was able to raise capital. So we're seeing the evidence now for sovereign wealth funds coming into transactions again, and they're making money. So
starting now, but are they going to get more picky at all? I mean, having been battered and bruised.
Well, they are being picky already. That's a good point. They're being very selective, but because money's being made, that attracts money. And a lot of people believe the turn has taken place, and so now it's time to put money to work.
Okay, Gary, great to have you with us, and thanks so much for joining us in the studio. That was Gary Parr, Deputy Chairman of Lazard.